Hello, welcome back to the channel. We were studying law of real estate under our previous lectures, and we have seen some lectures on rent control laws. We have also seen the effect of Rent Control Act on the properties. So today is our last session on Rent Control Act. We will conclude Rent Control Act today. So this is the part 4 of rent control laws. If you have not seen my previous lectures, please go and watch them. After watching them, uh, you will understand this lecture better. So today's topic of discussion is valuation of rent control properties. We will continue it, and we will see some studies which was conducted on rent control properties to get the idea how we should approach to the rent control properties. Then we will see analysis of transactions. This is also the part of studies, and after that we will conclude the session. Valuation of rent control properties. So let's see. The properties subjected to rent control acts are fetching rents. Okay, so they are generating income, and this income that much less than the market rent. So the properties which are subjected to rent control acts fetch less than market rent. Okay, so the rent control properties are in the category of income fetching and marketable, and can be therefore by valued by income approach. So as they are marketable and they are also income fetching, we will do the valuation by income approach. Do not worry, we will learn income approach, cost approach and market approach in the method of valuation. For now, you just remember the name of the approach. Okay, do not worry, we will cover all the approaches and their case studies as well. The two main questions which come in the mind are, the first is, what rent or net income should be capitalized? So generally in an income approach, we calculate net income, then we capitalize it with certain rate. Okay, this we will learn in methods of valuation. And the second question which come in the mind of valuers, what should be considered as appropriate rate of interest for capitalization? So these are two main questions. Answers of these questions can be found to some extent by the study of local market of such rent controlled properties. Okay, so we will see a study which was conducted on the rent control properties. Let's see. With a view to study the effect of rent control acts on values of properties, some student of Master of Valuation in the subject of real estate, Sardar Patel University, Ballabh, Vidyanagar, Gujarat, so have undertaken study of rent controlled property markets in a local area of Nasik, Solapur, Mumbai, Anand, etc. These research papers suggest possible answers and the method to find answers to the above two vital questions. So answer of these questions, these two questions were given in the study. So let's see. First approach was sale transactions. So in this approach, three types of sale transactions in respect of properties occupied by tenants protected under the Rent Control Act but generally noticed. So there were three types of properties occupied. In the first type, developer or builder have purchased property with encumbrances of tenants, either paid off the tenants or sold them flats at concessional rates. So what they have done, they sold the property to the tenants with some discount, that is charging them only cost of new construction, and demolished old buildings and reconstructed new building. So what they have done, they purchased a rent control premises, then sold it to the tenants by constructing the new flats. Okay. In the second and third type of transaction, either one of the tenants or the societies formed by the tenants have purchased the properties with tenants and retained old buildings with or without repairs. So in the second and third type, what they have done, the properties was sold to the societies, okay, with or without tenants. So in all the three types of transactions, the information about consideration, that is the actual price paid, including unaccounted money, if any, could be obtained. So we know all the information about the amount, about the consideration which was given. In the first type of transaction, we are talking about the land value. In the first type of transaction, since the old buildings were demolished, the consideration paid to the landlords represented the value of land, but only partly. So what they have done, they purchased the old building, they demolished that, and they sold land, okay, directly or indirectly. By demolishing the old building, they have sold land only. The other remaining part of the land value has been represented by the amounts paid to tenants, either directly for buying them off or indirectly by way of cost of concessions given to the tenants. So in our previous slide, we have talked about the concessions which are offered to the tenants so that they can I must say they can buy the properties. Okay, so they give some concessions in the form of difference between the market value of the flats and the cost of construction of the flats, either partly or fully charged to the tenants. Okay, so what was the two parts of the construction? The first was the land value and other was the value which was paid to the tenants or the concession rate. So by adding these two, we got the final consideration which was given. Thus, the land values virtually paid by builders or developers were the consideration actually paid to the landowners, plus the amount paid directly or indirectly to the tenants by way of payoff or concession. So tenants got flats in concession because the property was affected by the Rent Control Act, and we have seen that tenants have the right to get tenancy in the new building. So what builders have done, they give some concession to the previous tenants and said that purchase the new flats. Okay, so it was noticed that the total land values thus virtually paid off, including payoff and concessions given to tenants, were about 70% of fair market values of similar and comparable open lands in the respective localities. Okay, so this was the case. So now we will do a small analysis of these transactions. Okay. For the purpose of analysis of sale instances, gross and net income from tenanted properties was estimated. So what we have done, we have calculated the gross and net income from the properties on the basis of controlled actual rents paid by tenants, and secondly on the basis of fair market rent. So we have, what we have done, we collected market rent data, we collected the standard rent, or I must say the rent was paid by the tenants. We have calculated both separate, and then we compared them. Okay, rents estimated by comparison with rents fetched by similar comparable properties, particularly of similar type of construction, similar age and similar state of repairs, maintenance and services. So what we have done, we took some similar properties and do market survey about the rent which they were getting to get the market rents and standard rent we know from those properties only. So properties were compared more objectively following Betis system. So what is this Betis system? We will study later. For now, just remember the name. Net income was estimated by deducting actual taxes, 10% of annual repair and maintenance, and 1% for insurance and management etc. So what we have done, we calculated the gross rent, we deducted these expenses, and we got the net income. The consideration actually paid, including unaccounted money. Okay, so we know the consideration, we deducted the expenses, and we got the consideration which was actually paid. Including uncounted money was ascertained by inquiries with vendors or purchasers. It was found that YP on the basis of actual or standard rent varied from about 250 to about 300. So what was the result? We found that YP on the basis of actual or standard rent varied from about 250 to about 300. The YP is year purchase. We will study about it in the methods of valuation. On the basis of estimated fair market rent varied from 12% to 14%. Okay, on the basis of fair market rent. On the basis of standard rent, this was the variation, and on the basis of fair market rent, this was the variation, indicating reduction of 30% to 40% in the market value of properties as effect of or due to Rent Control Act. So what happened? Due to Rent Control Act, the reduction was 30 to 40% in the market value. Okay. So what conclusion we draw from the discussion of part 1, part 2, part 3 and today's lecture? We will see in the slides. So these are very small. So a valuer is advised to study the market of such rent control properties in his area. So you have to do the work or areas of practice. Analyze sale transactions involving such tenanted properties. So you will find the rates which are prevalent in your market where you are practicing, and find out YPs. So we will learn how to calculate YP in method of valuations. For now, just remember the facts, and appropriate rates of interest, single or double rate. These also we will learn as the case may be for capitalization. So valuer has the responsibility to analyze his market and find out the rates, okay, and YPs. Adopting ad hoc percentage deductions, that is notional assumptions, need to be discouraged and need to be avoided in any circumstances. So this is my humble request to you all, that do not assume any percentage. If you do not have data, do not assume. Prepare your data before assuming anything. You should have the background about what you have assumed. Okay, so this was all about Rent Control Act. Okay, I hope the Rent Control Act is very much clear to you. I have covered all the topics. You do not have to worry about any study material. Okay. Another thing about the MCQs, I will upload MCQs also. I am working on that. So just keep patience and keep supporting. Thank you all.